first question I asked them is the same as the first question I'm going to ask you guys, which is, who here wants to be wealthy? You can do show of hands.
I want to be normal.
Excellent.
I want to be normal.
You want to be normal? Is that what you said?
Mm-hmm.
Okay. So it's interesting. When I gave this talk to a room with like several hundred female professionals, no hands went up in the room. There were a few like little tentative, like this kind of situations, but for the most part, no hands went up. And I said, okay, what does it mean to be wealthy? I said, does anyone in this room believe, for better or for worse, that if you have more wealth, you have more power and more flexibility? Do we believe those things? I think we do. And wouldn't that be a good thing to have more power and more flexibility?
I don't know, but some people, if they have too much power, they can get greedy.
That is very true. And so I'm going to start sharing my slides because I have on the slide.
Greedy.
Yeah, I agree with that. I'm going to share my slides with you. So give me just a second to share this screen. Can you see that okay?
Mm-hmm.
Excellent. So here's what it means to me to be wealthy. And it's really up to each person. Like, your definition of what it means to be wealthy doesn't have to be the same as mine. But my favorite definition is having enough money and resources to buy everything my family needs and a lot of what we want, while still saving for our future and being able to help other people. How does that make you guys feel?
Good.
Yeah, like that seems like it'd be a pretty good thing. Yeah. And when I explained it that way, and then I asked again to the women in this room, who here wants to be wealthy, every hand in the room went up. And so it's interesting that sometimes our feelings and emotions around money can influence how we think and how we behave, and even like some of what we want. Is that interesting to think about?
Mm-hmm.
Yeah. So, question for you. If you won $50,000 today, what do you think that you would do with it? Just yell things out.
Donate
to the
25,000.
Spend some and invest the rest.
That's excellent. I heard
Donate lots of donate half to charity.
Invest, buy video games and food and water for people who are poor and on the streets, and then
donate all of it.
Some to frontline workers.
And
get a free printer.
Those are all great answers. And
spend a quarter of it, invest half of it,
paint my room orange.
With a quarter of it, buy life insurance.
That's amazing. So when I gave this talk to my daughters, I said what I said on here at the bottom, which was there are no right or wrong answers. And my older daughter came back to me and said, well, actually, Mom, burning it seems like it would be a wrong answer. So I have a small addendum. There are no right or wrong answers, but burning it is probably the wrong answer. But every response that you boys gave is a great response, and there are no wrong answers. So what I am setting out to speak to you boys about today is to tell you a little bit about investing. And I know that you've already had some presentations, so you should have a head start. Convince you that anyone can invest, boys, girls, grown-ups, doesn't matter. That starting today is always better than starting tomorrow, which I'm putting in the air quotes because tomorrow kind of means like later, someday, maybe, whenever we get to it. And that small steps are great. It doesn't have to be some big grand scheme. That little baby steps.
Tomorrow is you're never going to get to tomorrow. Because when you get to tomorrow, it just becomes today. So tomorrow means never.
That is so true. And for a lot of people, the tomorrow on investing actually becomes never. So this slide is a little bit of my background, but what really matters for me with you boys is I'm an investor and I'm a mom. So let's talk about what is investing. Investing is buying something now with the expectation that you will make money off of it in the future. And so it's basically the opposite of instant gratification. Are you familiar with that term, instant gratification?
I think that's when you get money instantly instead of like in the future.
So instant gratification is this idea of getting pleasure for something now, as opposed to waiting to have something good later. So in instant gratification would be eating the cookie now, even if you know that it's really more time for the taco because you didn't have like, protein in a proper lunch. Instant gratification would be buying a Nintendo Switch, even though you were saving up to buy a MacBook. So it's this concept of like a push and pull between what you want in this moment and what you can have that's greater if you wait. And when we invest, we are putting money into something now with the expectation that it will be worth more later, but we have to wait. And the kinds of things that you invest in are a wide variety of things. And I have some listed on the side of this page, but basically stocks and bonds and mutual funds and ETFs, which are all terms that we'll talk about later in the presentation. You can invest in businesses, you can invest in real estate, so your a house, an apartment building, commodities like oil. You can invest in collectibles and art. Do you guys know of what a collectible might be?
Yeah, some Lego sets are collectibles.
Totally, yep, of Lego
Limited.
sets. Baseball cards could be collectibles, stamps, rare coins, like all different kind of things. And we don't always know, with investing in general, we don't always know.
Like my big penny collection. I have 255 pennies.
That's amazing. And are some of them special pennies, like copper pennies or older pennies, or?
I don't know.
You don't know, all right. So why do we invest? We talked a little bit about this idea that we're saving for long-term goals, but investing versus saving is important because savings alone isn't enough because of inflation. Have you heard the term inflation before?
No.
Yes, it's when things get more expensive over time.
Yes, that is a perfect definition. And the things that get a lot more expensive are actually things that are pretty important to us. So the cost of an education gets much more expensive over time. The cost of healthcare has gotten much more expensive over time. Are there any things that you know of that have gotten less expensive over time? Actually, you know what got less expensive over time? Computers and electronics. When I was in college, the computer that I had cost way more than my iPhone that's hiding over here and had like a fraction of the memory. So computing power is actually a neat example of something that got less expensive over time. But I digress. So we build wealth through the power of compounding. Now, you guys should be familiar with the term because I remember that you saw that in the video with Jeff. Does anyone remember what broadly the concept of compounding meant? It's okay if you don't. We're going to cover it anyway, but if you want to define it, you can. Okay. So we'll discuss compounding in a second. One more thing to point out is most people today do not get wealthy just from their salary, just from going to work and earning the money. Most people today get wealthy by building businesses or by investing, and a lot of times it's a combination of both. Yep, exactly. So now we're going to talk about compounding, and we're going to talk about investing, and in particular, this example is about stocks. Now, are you familiar with the S&P 500 or the TSX index? Are you familiar with the concept of a stock index? Okay, so the S&P 500 is an index of the biggest 500 stocks in the United States market by market capitalization. And market capitalization is basically the price times the number of shares. And so it's basically a way to look at the market, broadly defined. In the US, the top 5 companies are all ones I would imagine you've heard of. Microsoft, Apple, Amazon, Alphabet, which is Google's parent company, and Facebook. Have you heard of most of those companies, if not all of them, boys? Good.
I haven't heard of Alphabet.
You've probably heard of Google.
Yeah.
Yeah, that's just they did like a restructuring and they called the parent company Alphabet a few years ago. So over the last 90 years, the S&P has averaged about 10% return with dividends reinvested. And I looked up the TSX, which is the Canadian index, which is not normally in my presentation, but I know that you boys are in Canada. So that averaged for the last 50 years, 9.1%. So pretty close. And so for our compounding examples, we're going to use this concept of 10% annualized returns. Now, that's a simplification. Certainly in different years, the market goes up and down different amounts, but over time, that is what a typical investor has experienced. So we'll talk about compounding and how important it is to start young. So you see that in the graph on the left, there are 3 lines, a blue one, a yellow one, and a green one. If you invested $5,000 and it earned 10% per year, and you started at age 35, which of those lines do you think would show how much money you would have at age 65? Blue, yellow, or green? And you can just guess. You don't have to have a reason for your guess.
Blue.
You think blue?
Green.
Green? Okay. So
Yellow.
yeah, so whoever just said yellow, that is correct. So if you see there,
Yay.
if you invested $5,000 earning 10% a year compounding, so each year you reinvest your earnings and that continues to earn. If you start at age 35, you'd have $87,000. It's pretty good. If you waited 10 years and waited till you were 45, you'd only have $33,000. Definitely not as good. And if you did it earlier at 25, you'd have $226,000. Seems like a lot better, right? Makes a pretty big difference, right, boys?
Yep.
Yeah. Now, you guys are even younger. So if you jump in, like this really cute dog on my slide, and go even earlier, let's say that you start saving now so that when you are 15, you have $500. You save up some of your allowance, you save up some of your birthday money, your Christmas or Hanukkah or any kind of gifts, and at age 15, you put $500 in an investing account. And then you add $25 every month until you turn 25. When you're 65, you would have $293,000. Pretty good. If you added $5,000 when you were 25, which you probably, depending on what your career is, you'd probably have your first job by then. Then by age 65, you would have $520,000. How much money is that? Do you think you could buy a house with that? With $520,000?
Yes. You could probably buy like 4 houses.
I don't know if you could buy 4 houses, but you could definitely buy a house. The Canadian Real Estate Association said the average price of a house in Canada is $480,000. So yeah, you could buy a house. And many people use the target of having 80% of their pre-retirement income as what they want to have.
Going to cost like $100,000, not $400,000.
It totally depends. So averages can be misleading, but certainly with $520,000, we could buy a house. So people, when they're trying to retire, often say they want to have 80% of their money from before they retired. That would mean if you wanted to retire today, well, not you because you're young. If a 65-year-old wanted to retire today and they wanted to have $80,000 a year to spend, they would need to have saved up a little over $1.2 million if they think that they might live for 30 years. So you could see it would take like some pretty hard work to save that much, right? And so starting
Warren Buffett has a lot.
Could you repeat that, please?
Warren Buffett has a lot, though. When
Warren Buffett.
He started.
I think he did start early. Yeah. I think he started with investing money from his like paper route in high school. It's been a while since I read his biography, but I do think he started when he was still a student. So as you have this in mind that you want to be saving and you're young, you might wonder, like, how do you know how much to save? So some grown-ups use this 50-30-20 rule, where 50% of their take-home pay, which is the money that you get to keep after taxes, goes to needs. What are some things that a grown-up might need?
Groceries.
You can make up ones that aren't on my list too.
Basic clothing.
Mm-hmm. And then 30% goes to wants. So what are some things that grown-ups and kids could want?
Video
Theater. Zip lining.
Video games.
Mm-hmm. Super fun. I love concerts, or I would love to go to them again when we're in the regular world again. And then another 20% can go to your future dreams. And so future dreams are these things that are not instant gratification that you have to work
And you
hard
only
to
have
have
20
later.
slides left.
Sorry?
You only have 20 slides left.
You have 25 left. What do you mean?
You only have 20 slides left.
Oh, don't worry. Some of them are just like flippy. It's not so bad. So 20% go to future dreams. So things like saving, paying down debt, and investing. So here's a little fun trick for you. Do you guys like math?
Yeah, kind
Yeah.
of.
Love math.
Kind of. Well, this is easy, fun math. So
Yay.
here is called the rule of 70. The rule of 70 helps us figure out approximately how long it will take to double our money. And the way that you figure it out is you take 70 divided by the rate of return on your investment to get the number of years to double. So we talked in our example earlier about a 10% return. So if you take 70 divided by 10, you get 7 years to double. Now I said that we don't always get 10%. We don't even always know upfront how much our investment is going to return. So this shows you the differences in what those rates will get you over time. So if we only earn 5% on our investment, it'll take us 14 years to double our money. If we earn 7.5, it'll take us a little over 9. So that's something you guys can play around with. Now, we're going to talk about some investing terms, and we'll start off with stock, which I think you've heard before. And we'll talk about these two companies. You guys familiar with Disney and Amazon?
Yes.
Yeah.
Okay. So a stock is a small ownership stake in a business, and when it's publicly traded, anyone can buy and sell the stock on the stock exchange. You make money when the prices go up and you sell them at a higher price. If you sell it at a lower price, you lose money. And some stocks also pay dividends. So let's talk about Disney first. How do you guys think Disney makes money?
It charges you, so you cost money to make an account.
Well,
And
Of what kind of account?
they make
an account where you can watch movies on it.
Right? Like
Like
Disney Plus or
amusement
something?
they make movies and then they put them online for money.
Yeah.
Amusement parks.
And they also make it so like you can see the movies to see they're good because you get a free trial. You get to see the movies are good. Then you have to pay to see more movies, so you're probably gonna pay.
You guys are totally right. So Disney makes money from their media network. So
Theme
their
parks.
Disney Channel and ABC, from the theme parks, the cruise lines, and the vacation club, from their motion pictures, their movie studios. You guys, not only Disney movies, but they own Marvel. Anyone like Avengers?
Kind
Yeah.
of.
And
Do they own Harry Potter?
they do not own Harry Potter. I think Warner Brothers owns that. But they own
Yay.
Lucasfilm, which is all the Star Wars stuff. They own
Oh,
Marvel,
that's
which is
cool.
the Avengers and other superheroes. They own Pixar, so things like Toy Story, so lots of movies. And then
Do
they
they
also,
own Ready Player One?
that's a good question. I don't know the answer to, but it's a great movie. And then they also,
No, it's still on Netflix, so
well, you know, that it could still be on Netflix. They haven't moved all their content off, but we digress. So they
No,
also,
they don't
No,
have
then I
it.
think
It's
they
not on
actually
Disney
might.
Plus.
okay. So they also have these direct to consumer things like Disney Plus and Hulu. And you can see on those little pie charts that their revenue, so they bring in money from all those different businesses. But do you notice in the one on the right that says operating income, which is really profit? Do you notice there's none of that like really dark blackish blue? That
Mhm.
means for Disney Plus and all those other things in the bottom, they're not making any profit off of it yet. So it's interesting to see that companies can start off businesses that eventually will be profitable, but it might not be profitable right away. So that's how Disney makes money. How do you make money if you own Disney? Which of these things would happen? Is it true that if the stock
goes up.
and you sell it, you make money?
Uh-huh.
Yep. What about, is it true that you would get dividend payments from Disney? Dividends are when they return some of the profits to their investors.
You could.
Yeah, Disney pays a dividend, so that's true. And what about, do you get discounts on Disney products?
Yeah.
Yes.
No, actually, I don't think you do. There's some companies that give you discounts when you own the stock, and you actually brought up one of the more famous ones, which you might not realize, but Warren Buffett's Berkshire Hathaway has discounts for their shareholders, along with like a very small number of other companies, but
Oh.
Disney does not. So there you go. If it goes up in price, you make money. You can make money from the dividend, but that's it. how does Amazon make money? How do you guys think?
North America.
That's just the geographies. You're going to have to actually think about it. How does Amazon make money?
They
Like, what do
sell
do?
stuff.
They sell stuff. Yeah, that's a huge piece. And then the piece you might not have heard of says AWS on there. AWS is Amazon Web Services. They actually have a massive cloud computing business that not all people have heard of. And you can see on the left, it's the orange coral piece of the pie is pretty small, but on the right, the amount of their profits, it's actually really profitable. So it's kind of neat to see how a small piece of their revenue could lead to a big piece of their profit.
Yeah.
So
Amy?
how do you make, yeah.
Ready Player One was Warner Bros.
Warner Brothers? Yeah, that's the same as Harry Potter, I think. So for Amazon, if the stock goes up and you sell it, do you make money?
Yep.
Yep. What about dividends?
Maybe.
Yeah, it is. That was a trick question. You actually don't get a dividend from Amazon because not all companies pay dividends, and Amazon's one of them
Oh, so you
not.
get less money if you get on Amazon than if you are on Disney.
Well, it's
knew
different. A
it.
lot of times if companies have high growth, they keep the money and they spend it inside the company to accelerate growth. So you bring up a great question. So here's a chart of 3 things over the last 5 years. One of the lines is Amazon, one of the lines is Disney, and one of them is the S&P 500 index for reference. So one's orange, one's blue, one's gray. Anyone have any guesses for which is which?
Amazon
I
is
have one.
orange, Disney is blue, and the last one is gray.
Yeah.
That's a really good guess. It's very close. So Amazon is the orange, Disney is the gray, and the S&P 500 index is the blue. So
Man,
it's kind of-
Disney's going down.
Well, it went,
Oh.
yeah, it went up barely, but not enough. And so it's super interesting to see, even though in that other chart we saw there, you can make money in 2 different ways from Disney. That doesn't necessarily mean that you'll make more money. And as you can see, Amazon has had explosive growth over the past 5 years. So another investing term is a bond. And a bond is this concept of you loaning money to a government of a corporation and they pay you back plus interest.
Which is
Now,
making money.
now, does it go the other way too? Do people borrow money?
Yep.
What are some things that people might borrow money for?
From the bank to
Well, that's
get
who you'd buy it from, but why?
Houses,
house.
cars.
Houses and cars. Some people have student loans for college. People have credit card debt. So it works in both directions. So sometimes you're lending money. If you're buying a bond, you're lending. And if you're having a mortgage or a car payment or a student loan, then you're a borrower. These are some other investing terms. Pardon me. So diversification. It's a big word, but it really is the investing concept of not having all your eggs in one basket. Have you heard that expression
Yep.
before? Yeah. So tell me what it means to not have all your eggs in one basket.
Because then if you drop the basket, all the eggs will probably crack and then you lose all your eggs.
Yeah,
And
and that's exactly right. And so you don't want to have too much exposure to any company or
Yeah, like
sector.
you don't want you don't want to invest only in one company because then if that company fails,
Yeah, it's 100% true. And you know where people get into the most trouble with that? When they have stock in the company they work for. A lot of times people will get stock as part of their pay, or they'll get discounted stock, or they'll get options. And sometimes you can't help it. But for example, I once worked for one of the banks in the US called Bear Stearns. And during the financial crisis, I didn't work there anymore. But my friends who did, some of them had millions of dollars in Bear Stearns stock, and the company went out of business during the financial crisis. And they went from having millions of dollars to like pennies overnight. And like, that's pretty painful, right?
Mhm.
Yeah. Then the next term is asset allocation, which also sounds fancy, but that really just means how you divide up all your investments. So what do you have in stocks versus bonds? How much is in your home country versus the rest of the world? How much you have in developed markets? How much you have in technology versus healthcare? All those different kinds of things. Now, you might wonder, like, how do you know how much you should invest? And it's a very good question, and it's a personal decision because every person's risk tolerance is different. What do you think risk tolerance means?
How big they're willing to take risks.
And how it's really, remember we talked a little bit earlier about the emotions involved in money? Risk tolerance is part based on like actual math and like the analysis, and it's part based on how you feel. Like what would happen like inside your heart if you lost that money? Like would you be able to keep going, like, or would it be so upsetting to you that you couldn't possibly bear it? And so each person needs to figure out what they're comfortable with in terms of the amount that they want to invest, so that you don't invest more than you're okay losing, but you have to balance that with not being too afraid to start. And the good news for you guys who are getting educated about this so young is that longer time horizons allow for more risk taking. And the reason for that is because you have more time to earn back losses. And also you can keep investing at a regular interval. So if you're investing and markets go down, you're basically buying stuff on sale, right? And so when you do that, you're sort of averaging in over time. So with that as context, how do you decide how much to invest? A common guideline is the rule of 100, which is basically saying that the percentage of stocks that you would own, all other things basically equal, would be 100 minus your age. And interestingly, for women, we often adjust it to the rule of 110. And the reason for that is that women are projected to live longer than our male counterparts, which is a good thing for women, but women also can sometimes be paid less than our male counterparts, and that's not as good. And we don't have to go into that in depth. It's more of a discussion for another time, but just something interesting for you to think about. And also, if any of your sisters end up watching this, they might find that interesting. So how can we increase our chance of success? Well, we start early, which it's great that we're having this discussion. We keep investing, and we have an appropriate asset allocation. So like we talked about, not having our eggs in one basket. And you need to review the asset allocation periodically because things will move around and you might need to readjust. So we'll talk about some other terms briefly. We don't want it to get too boring, but ETFs and mutual funds are interesting because they let you invest in a variety of stocks or bonds without personally having to pick. So you saw on that other chart what a big difference it would make if you chose Disney and not Amazon. It may be that for a portion of your investing, you want to pick stocks, and for a portion, you just want to have general exposure or broad-based exposure, or let someone else choose the exposure. And ETFs and mutual funds are ways that you can do that. Now, do you think most adults are invested?
Maybe.
Maybe
I know my parents are because they talk about it a lot.
Yeah.
But no,
so most adults are invested, but your maybe response is pretty good because actually, at least in the US, about 55% of adults are invested. And a lot of them are invested in one of these, a lot of them are invested because of retirement plans, which is often tax advantage because governments want people to have money saved for retirement. People may also have savings for their kids' college. So your parents may be saving for you already. And then they may have brokerage funds and other investments. But you're probably more interested in how you can invest for kids if we're talking about this, right? So the ways to invest for kids is you can ask your mom, dad, or loved one to buy you a share of stock. So we use Amazon and Disney as an example. Actually, the reason why I use those is because 2 years ago for Hanukkah, we let each of our daughters pick a stock, and those were the two they picked. And so we have been following them in our house for the last 2 years, and they've actually been super interesting examples because they've been so different. You could ask mom, dad, or a loved one to open a college savings account for you, or if they've already done it, you can thank them for it, and you can ask them about it. And then your mom, dad, or loved one can open an account for you. In the US, that's called a UTMA account. I apologize, I don't know the Canadian term for that, so you might have to ask your parents to teach you about that one. So now I'm going to give you 7 investing tips. Although the first one's kind of funny because my first tip is always be suspicious of tips. So when I say always be suspicious of tips, it's when you're bigger, or even maybe now, people may say to you, hey, Mac, you should buy XYZ company. And a good rule of thumb is to always do your own work. So just because someone tells you something's a good investment, my former business partners like to say, trust but verify. It's great to get investing ideas from other people, but you need to do the work. And it's one of those, like, if it seems too good to be true, it probably is. So be suspicious. Number 2 is that investing is a long-term affair. Don't look at your accounts daily. It'll just make you crazy. For us, I look at our accounts on a monthly basis, and I update my husband, because I actually run the investing in our house. I update my husband on it 4 times a year. We talked already about number 3, don't put all your eggs in one basket. So I think you already get that one. Don't invest what you can't afford to lose. So let's say that you were saving up. Do you guys already have Nintendo Switches? My daughter's obsessed with that because of Animal Crossing. Or is anyone wanting one of those that doesn't have it yet?
I saved my money for something, but I just got it.
Oh, you just got it. Okay. So
I have a Nintendo
today.
Switch.
yeah. So if you are really close to the time horizon that you want to buy the thing that you're investing, then you have to get more conservative. You have to pull some of that money away. You want to make sure that up front, you don't invest more than you can lose, meaning you've got enough savings for emergencies. Like a lot of people have lost their jobs with COVID. It's super important before you invest to have an emergency savings account. And you want to make sure that you have the money that you need pulled away. So as another example, my daughter's getting close to college. My older one is a freshman in high school. So we are moving money out of stocks in her college account to more conservative things to make sure that if the market goes down between now and when she starts college, we have this money that we've saved for her. So we're always monitoring like where we are versus what we're saving for to make sure that we don't lose money we need. Another tip is keeping your fees low whenever you can. So we talked about what your investments can earn, but investments also have a cost. And whenever possible, we want to make sure that the costs, which deduct from what we're earning, are low. My next one is don't invest in anything that you could not explain to someone else. What that means is some investments are complicated. I have definitely invested in things that I needed lawyers to help me understand. But a good rule of thumb is to never invest in anything until you get to the point where you could explain it to someone else. So it may be complicated, but like a good check that you understand it is that you would be able to explain it to a friend. Much like if you're ready for a math test, do you think you could teach someone else the subject that you're going to be tested on? Is that a good way to tell whether you're ready? What do you think? Yeah, I'm seeing some nodding. Good. Yeah. So a good test that you understand an investment is that you could explain it to someone. And then the last one is creating habits and processes that will help you. I love automatic investments. That's when either out of your paycheck or out of your bank account, that money gets taken and put into savings or investment straight away. You don't have to touch it. Even with my girls, we have some allowance that they get in cash, but a portion of their allowance goes straight to a bank account that they don't see. And a couple times a year, we'll log on to the account on the computer and show them how that money is magically growing because we're adding to it and it's earning interest and we're leaving it alone. So automatic investments are a great way to do that. And then another tip for down the line, but we could adjust it for kids. So as an adult, when you get a raise, so you have a job and you do a great job at work and you get a raise, they give you more money. Before you get used to having more money, you can take a portion of it and start investing it straight away because you weren't used to having the more money. You're used to living your life on the money that you had. So every time you get a raise, if you take a bunch of it and add to your investing, you will grow your investing over time. And what you can do as kids with that is maybe you decide every time you get money as a gift, you put 10% of it in an account. You decide the amount, but these little pieces over and over, especially when you're young, are hugely powerful. So that's the prepared part of my presentation. And I want to know how you guys think we did and whether you have questions. So I hopefully convinced you that anyone can invest, grown-ups, kids, boys, girls, everyone, that today is better than imaginary tomorrow that we talked about, and that small steps are great. So I would love to answer any questions and also hear how you guys think we did with that.
I think I know more about investing than I did yesterday.
Yeah.
I view that as an excellent result. Thank you. Are there questions I can answer? Are there topics that I didn't cover that you are feeling curious about? Okay, amazing. Well, thank you so much for letting me be a part of your COVID-19 strange learning from home extravaganza.
Absolutely. Thank you so much for joining us. Sometimes no questions is a good
Thank
sign.
you.
So thank you so much.
Absolutely.
Oh, I have one question.
Go
more
for it.
question. We watched a video
Mm-hmm.
that for our guest speaker research, and it was Julia. Does she know about the video that we watched?
No.
Okay.
But you can try me.
Because there was this guy like Pete. His name was Pete, and when he got his money, which was $1,000 a month, he spent it right away.
Mm-hmm.
And there was a guy named Tom who saved most of his money and invested, so we got more money in the end.
Yeah.
So do you think there's more people like Pete or Tom, and why?
Oh, that is a really good question. So most people spend the majority of what they earn. And the why, I think, is complicated. I think that there are a lot of people in my country and your country who really have trouble. Are you familiar with the expression making ends meet?
Yeah.
So I think that if you're having trouble making ends meet, if you need every dollar that you're being paid just to pay the rent, just to keep food on the table, just to get transportation to and from work, it is almost impossible to invest. There, you have to achieve a certain level of economic stability in order to be able to invest. And that is challenging, and I definitely don't have the answer to that. So what I can say is there are also lots of people who can make ends meet and do have excess money, and they are more dealing with the instant gratification question. Should I save the money today or should I spend the money today? Do I want to go on a vacation that I can kind of afford and just put it on my credit card and pay it off over time, which is very expensive, versus should I save some money, invest some money every month, and then wait to take the vacation until I have the money saved? And these are hard issues, even for grown-ups, but I think when you're starting out young, and if we're looking for what our goal should be, what we should be striving for, I think we want to strive, or I certainly can say, like, for my children, my goal for them is for them to live a life within their means where they only buy things that they don't need when they can afford them, so that they will have savings to last their lifetime, as opposed to living a life where you're constantly struggling. But there, not everyone has that opportunity. I think when you go to college and you get a good job, you have opportunities that not everyone in the world has available to them. So it is a hard question. And I know that was a long answer, but do you feel like that answered your question?
Yes.
Okay. Any other questions? All right. Well, if there's anything else you need, I know your teachers have my email address, and I am more than happy to answer questions at a later date. And I thank you, and I enjoyed your engagement and your curiosity, and I hope you have a great day.
Thank you so much. This was awesome.
My pleasure.